check. Then that of Victor is we supposed to pay Victor 120, but we are giving 5% discount. This is a 600 divided by that is 6 naira. So we have to pay 114. So we are given under Victor, we are given 6 naira discount, of which we have to pay, instead of paying 120, we pay 114 naira. That is that. So we receive discount because we pay by check to Guju, Festus, and Victor promptly because we paid the cash on time. So we are able to receive the discount. Now, next question says August 25 received a cash loan of 700 from Ladipo. That means we receive a check, which is a loan. So August 25 loan. Ladipo give us loan. How much is that loan, which is a loan on cash, which is 700 naira. And now it's 700 naira. Then August 27 paid electricity by check. Electricity is an expense. August 27 we paid electricity, and that is 20 naira. That is by check. That is by check. Then, having done this, we now add the total of this and the total of this to know whether we have a balanced BD or not. Now, and to know the total discount received and the discount allowed at the end of the year. So when we add the total of this, then you find the difference. Now the total of this is 2,570, and the total of the bank loan is 3828. Then the discount allowed is 92. Now, after adding this, you see that the debit side is greater than the credit side, of which we have a balance CD. So the difference of this and this in the cash column is 1,210, while that of a bank column is 2051.5. Then we balance it 270, then 3828. Then that of this is 13.2. That is this discount received at the end of the year. Now we now bring it down here that balance August 31st, balance CD. That is at the end of the day, at the end of the month, the balance of the cash book we have here in cash is 1,210, while that of bank column is 15,000. That is 2,051.5. So we leave this one. We don't read balance video under this one because it is a discount. It has nothing to do with the balance. So it is the buyer that enjoys discount receipt, while the seller also gives it up. So it's not going to be under it is the difference between the cash of the side, both sides, and the bank. It is what you bring the balance down here. Now, You can as well prepare the ledger. You might be given the question that prepare three-column cash book and prepare the necessary ledger. Like I said the other time that it is until when you prepare ledger account for each items that is then you are complying with the double entry principles, because these items have any item that has credit side must have debit side, and any item that has the credit side must have debit side must also have the credit side. Now I will just do just 3 examples and to know how you post them into the ledger. These are 3-column cash book. Like I said that it is when you prepare the ledger that is then you are complying with the rules of double entry. I will use 3 or 4 examples to know that each items must have their own account, separate ledger. Let me start from August 1. Here it is on the debit side of the cash book. You prepare what? Capital account, debit and credit. So under capital is a liability according to accounting equation. Anything that has to do with capital, because the reason being that capital is a liability under quantity concept. In as much business has been registered, it is separate from the owner that has interest. So any money put into business, any money that you put into business is in form of capital. So that's why capital is a liability, and you know the techniques I gave the other time that anything that has to do with liability must be credited. So since the capital in the cash book has the debit entry, must also have the credit entry. August 1 cash. That is 3,000 naira. So by doing this, you see, it has a debit side and it must also have a credit side. So we are crediting anything that has to be capital, you credit it. Then sales. Let me use sales. You prepare sales account. It must also have its own, because all these items must have their own. You must prepare the ledger for them. Ledgers must be as much as you can prepare 50 ledgers. As small as ledger is a permanent account. Anything that has to do with sales is a revenue. So yeah, it has to be credited. It has been debited here, it has to be credited in the ledger. August 5 cash 370. That is that. Then let me use rent. Rent account. Rent is also an expenses, and anything that has to do with expenses, like I said the other time, that expenses has to be debited. It has a credit entry here in the 3-column cash book, and it has to be debited here. August 3, you rent cash, which is 500 now. Let me use the last one, purchases. Purchases account. This is a purchases account, debit and credit. It has a credit side here, must also have the debit side, because purchases can also term expenses. So August 13 cash, then that is a 3 August 13, that is 130. That is that. Then let me take another one, which will be the last. Let me take another rent. August 15. Rent. Another rent account, because we are having 2 rent accounts here. And don't forget, this August 13 rent is under what? This August 13 rent is August 15. This August 15 rent is under bank. So you represent it with a bank. August 15 bank, which is 25. Then let me give another one. we have a Gunju. You prepare Gunju's account, you prepare Vestor's account, you prepare Victor account. So under Gunju here, bank, it is credited. Gunju's account. So Gunju here is a bank. Gunju is August 14, August 17, sorry, and that is 95 now. So we represent the bank because the transaction is done through the bank. So there are many items that you can prepare to an ledger for it. I told you that you can prepare as much as many ledgers, 50 ledgers, depending on the items you are preparing. So by preparing ledgers for each item, you are fulfilling what we call double entry principles. Now we'll be talking about a petty cash book system. Under it we have an impress system under petty cash book. And what is the meaning of a petty cash book? Petty cash book is the book of original entry or prime entry, which is used for recording small disbursement or expenses, e.g. postage, stationery, and transport, and many other things. Like the reason why petty cash book is different from those single entry is that it is